Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the S&P E-Mini, the Mini-Russell 2000, and the crude oil markets for Tuesday, June 21st. As we discussed in yesterday's technical blog, defining the 1277.25 corrective high from Friday in the September S&P contract shown here on an intraday 4-hourly chart, the markets break above that level overnight on a very short-term perspective confirms at least the short-term trend is up, and we believe defines yesterday's 1256 low now as a tight but objective risk parameter this market is now required to fail below to expose or confirm this recovery attempt as just a three-wave and thus bear market corrective sequence we suspect it is. Until or unless such weakness below 1256 is proven, however, at least the short-term trend is up, and we anticipate a larger degree, a relatively larger degree correction of at least June's portion of the developing decline that we think is part of a much larger degree correction or reversal lower. And as we've mapped out here, the 38, 50, and 61.8% retraces for what they're worth of June's 1342 to 1252 decline cut across at 1287, 1297, and 1308 respectively. It's important to keep in mind, however, that within the context of what we believe is a broader developing bear trend shown here on the daily bar chart, that even a 38 to 50% retrace of June's portion of the decline, the 38.2% retrace on this active continuation chart basis cuts across at 1289. Such a pop remains well within the context of the broader down channel and could easily be, as we suspect, just a fourth wave correction within this broader slide. And on this larger degree scale, you can see the bullish divergence in short-term momentum that defines the 1256 short-term corrective low as a tight but objective risk parameter. But on this larger degree scale, we believe we need this market to prove strength above the 13 and a half low close from May 24th to expose the entire May-Jun sell-off attempt as just a three-wave and thus major bull market corrective sequence. We're taking that corrective low daily close from a daily close basis shown here. You can see the developing impulsiveness of this decline and the relatively minor amount of strength the market has shown thus far, given the downside potential of the past month and a half's break that counters arguably the July 2010 to April 2011 entire rally that's arguably a complete five-wave Elliott wave sequence. We've clearly had a trend break of that longer term uptrend that exposes a larger degree correction or reversal lower. We should require much better proof of strength needed to negate that larger degree correction, and we believe that proof of strength will come on daily closes above that May 24th low, a corrective low at 13 and a half, so let's say 1314 on a longer term risk parameter. These issues considered, shorter term traders with tighter risk profiles have been advised to neutralize or step aside from bearish exposure in order to allow or circumvent the risk from a short to intermediate term corrective pop. But from a longer term perspective, we advise traders to approach this near term expected recovery as another bear market correction and selling opportunity ahead of further losses down the road, with strength above 1314 on a daily close only basis required to negate that larger degree correction or reversal count lower and re-expose the secular bull trend. Similarly, looking at an intraday chart of the September Mini-Russell contract, you can see this morning's break above the 79.29 corrective high from last Tuesday that confirms a bullish divergence in momentum shown here on the daily chart that we believe stems June's portion of the decline from an 85.20 high to the 76.84 low from last week, exposing what we advise traders to first approach as a bear market corrective recovery and selling opportunity. The 38.2% retrace on this daily active continuation log scale basis chart cuts across around 79.93 and near the upper recesses of the broader down channel. And similar to the S&P longer term risk parameter, we believe the low daily close from May 24th at 80.92 is the level this market now needs to close above to expose the entire May-June sell-off attempt as a three-wave and thus potential bull market corrective sequence that might re-expose the secular bull trend. In lieu of such strength above 80.92, this short-term strength is advised to be approached as a bear market corrective recovery ahead of further losses. You can see here on a long-term weekly log scale perspective, the extent of the May-Jun sell-off was sufficient to confirm a bearish divergence on this long-term chart. You can see the rolling over of this year's waning upside momentum and rollover rounding top potential that exposes a much larger degree correction or reversal lower. In some, traders are advised to, shorter-term traders with tighter risk profiles have been advised to move to a neutral sideline position in order to circumvent the interim risk of a corrective pop, but longer-term traders remain advised to maintain a broader bearish policy with a close above 80.92 required to mitigate that sufficiently to warrant moving to a neutral sideline position. Finally, and as has been the case with a number of the commodity sectors, that have been taking their clue from short to intermediate term performance in the equity indices. You can see here from an intraday 4-hourly chart of the August crude oil market, the recovery over the past day and a half, sympathetic with the rebound in the S&Ps, that we advise to first be approached as a corrective selling opportunity as well. On this intraday chart that details this month's broader break below significant former support in the 96 handle area that now should be approached as a former support new resistance. You can also see 95.88 level being a 38.2% retrace of the most recent portion of the break from 102.95 down to 91.51. So for shorter term traders with tighter risk profiles, we believe the 96.20 corrective high from last Thursday is the short term specific level this market is required to recover above to break this downtrend sufficiently to warrant shorter term traders with tighter risk profiles to move to a neutral sideline position. From a longer term perspective, looking here at a daily bar chart on a log scale perspective, you can see the market's position below a ton of former support turn resistance from that lateral triangle consolidation that ranged from early May to mid-June before the market finally resumed that early May decline. We need proof of strength above the 102.44 corrective high from June 9th in order to confirm the entire May-June sell-off attempt as a three-wave and thus major bull market corrective sequence. In lieu of such proof of longer-term strength, longer-term traders are advised to approach this current interim recovery attempt as merely corrective within a much broader slide to what could be significant levels below the 90 level. Here on a daily log scale perspective, close only perspective on an active continuation chart basis, you can see the argument that all the price action up from the 25 May of 2010 low at 68.75 is arguably a complete 5-wave Elliott wave sequence, now prone to a larger degree correction or reversal lower. You can see the markets break below a ton of former support in the 96 to 97 handle area that now, per any broader bearish count, should be considered very stiff resistance ahead of a continuation of the May-June decline. And on this broader scale, a daily close above 101.93 is required to confirm the sell-off attempt as a three-wave and thus bull market corrective sequence. These issues considered, longer-term traders remain advised to maintain a bearish policy with a proof of strength above 102.44 on an intraday basis required to negate that count and re-expose the secular bull trend. From a shorter-term perspective, shorter-term traders are also advised to maintain a bearish policy with strength above 96.20 sufficient to warrant stepping aside to circumvent the interim risks and unknown heights of an interim bear market correction or quite possible broader reversal higher. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.